interestingly, and particularly for this audience, is the treatment of carbon-intensive sectors, and that focus on not wanting to have solely paper decarbonisation of portfolios, but really to remain invested, to work with companies and to support them on that transition. And if we think incumbents are actually, in many cases, very well positioned to transform their business models and to emerge as the leaders of the future.
Welcome back to the Decarb Connect podcast. I'm Alex Cameron, and I'm really pleased to be joined by Ewa Jackson today. Ewa is Managing Director of the Sustainable and Transition Solutions Group at BlackRock. And this is probably the fourth attempt of mine to have her on the podcast, because life is life and work is work, but I couldn't be happier. Really glad to have you here, Ewa. And today we're going to be talking a little about, obviously BlackRock and their perspective on all things climate, but more specifically, climate metrics and how they can be used to catalyze investment flow. So probably unusually for Decarb, this is slightly broader than our usual industrial emissions focus, but still highly relevant to that. And again, Ewa, so pleased to have you here. Maybe you can kick us off with, how have you reached this moment in time, both personally and professionally? I mean, fantastic company to be working for, amazing side of this whole climate debate to be working on. Give us your view of how you've landed here.
Firstly, thank you so much, Alex. I'm delighted to be here, and I'm so glad that we actually managed to make this happen. So I'm really happy to be here today. And as part of this podcast. So I lead the sustainability client team at BlackRock. I joined BlackRock 6 years ago, having spent a decade in banking prior to that role. As many of those listening probably know, BlackRock is a global asset manager. We manage around 9.1 trillion in assets under management across public and private markets. So really across the capital spectrum that of financing solutions. And our role as an asset manager is to be a fiduciary for our clients. So what that means is that we manage monies for our clients in line with the investment guidelines for our clients to build those portfolios and to build strategies to offer our clients with choice, but optimally achieve those optimal risk returns, which are resilient in the long term. So we invest for the long term for our clients. Now, my team and I do two things. So I lead a team of sustainability specialists across Europe, Middle East, and Africa, so across the region. And our focus is supporting our clients in implementing sustainability into their portfolios. Now, our clients are asset owners, they can be wealth managers, official institutions, family offices, endowments, and the like. So very much a broad spectrum of clients that we serve, and they may have different motivations for investing in sustainability, and we work with our clients on those motivations and to implement sustainability into their portfolios. And then the second aspect of our role is to work within ecosystems. And that means we represent our clients in those forums where it's important for us to have our clients' voices heard. So as an example, we sit on local industry bodies, the UK Investment Association Sustainability Committee being one. I sit on the Impact Investing Institute Advisory Council, and we have members sitting on various industry boards across Europe, really with that focus on supporting the ecosystem in developing the sustainability ecosystem and representing our clients' voices in industry. Now, I love working in sustainability. It's a fantastic role and a fantastic place to be at the moment, but it is complex. It brings together that broad ecosystem, meaning regulators, industry, clients, companies, really working together to achieve certain goals and objectives. So very much a fast-moving pace.
And then for you personally, I mean, you could have, with your background, you could have landed in any number of kind of aspects of the work that either BlackRock or any other global asset manager does. Like, how did you come into sustainability? Has it been a long-term goal, or is it, I don't know, is it some of the people I speak to, it just happened to be an opportunity that presented itself and they've stepped in? What's your personal story around this?
Sure. So I think it was a little bit by chance and a little bit in terms of wanting to orient my career in a different way. So I had worked on the sell side for a decade, and I was very attracted to the buy side given the long-term nature of investing. So I wanted to move to the buy side to really take on that investor outlook, and to think more about the investment thesis and more about those structural megatrends that exist in industry. So that was the rationale for the move to the buy side. And at the moment I joined, it was in 2017, and sustainability was beginning to really grow in terms of momentum. Of course, there'd been products for well over a decade beforehand, but it was starting to enter the mainstream. So if you think back to 2015, you had the Paris Agreement, you had then a slow upticking of companies and of countries beginning to adopt the commitments under the Paris Agreement, begin to make company pledges, investors begin to think through what does that mean for their sustainability propositions. So it was at that inflection point where it was about to increase in momentum, and it was just such a good place to be in terms of the growth business, because this was a need that our clients had, and which was emerging and becoming more tangible, as well as data becoming more tangible, and as well as that momentum overall. So really it was kind of that mix between moving to the buy side, as well as moving right at that point where this was really the business which was probably moving at the fastest pace.
So you've kind of come into it, as you say, that's a really interesting point in time to sort of see, but also to be part of really engineering what sustainable finance really has come to mean. I just want to take this opportunity to thank our production partner and sponsor, Jano Media, for their support in delivering the Decarb Connect podcast. Over the last few years, they've helped us to facilitate great conversations that connect us with our audience, and their skills and expertise mean that we get to concentrate exclusively on generating the content, the conversations that engage, inform, and inspire. Let's sort of talk for a minute about BlackRock and the lens that it brings to sustainable investing. I mean, without doing the full BlackRock pitch, what would you say is the kind of the lens that you and the team have? What is important within BlackRock about the way that you approach sustainable investment, which is, there are so many ways that different asset management, different financial companies come at this. What's the story for you guys?
Sure. So at BlackRock, we approach sustainability factors and climate risk in the same way that we approach traditional investing. So for us, this is very much the same approach that we apply across our investing business. And I think that's really important to highlight. We've touched a bit on the fiduciary role that we have. We've touched a bit on the client choice. But actually, if we think about our traditional investment business, the views that we take are underpinned by robust research, by data, and by analytics. And we leverage the robust research, that same approach that we take in terms of research, the rigor, the approach to data, looking at the material financial information that's relevant for a company valuation, looking at it from a sustainability perspective, those material non-financial data points relevant for a company. So we apply really that lens of research, data, and analytics, and that robust investment approach across our sustainability platform. So really, I'd say that's the overriding principle around BlackRock. As long-term investors, we are investing for that long term, and we're building those portfolios that are adjusted for resilient risk returns. What that means is that we identify climate risk as an investment risk. We identify sustainability factors as an investment risk. So we research climate in the same way that we research market risk, that we research liquidity risk, those credit risk and the like. So the traditional investment risk, we research climate in that same lens.
Okay, so that's already kind of interesting, because I feel, I mean, I'm sure most global asset managers in general, of course, would state very clearly that they are database, but it just feels like that positioning of it as this is just one of a number of risks. It just happens to be one that also has this kind of mega influence on the potential to hugely influence like how we deal with the climate issue in hand. So that's helpful. So when you think about Ewa in 2017, Ewa now, that kind of 5-year journey, what's changed? What's the sort of, we think about mood music when you were first transitioning into sustainable investment versus now. What's that shift been? maybe in terms of, how people talk about it, but also the participants, the drivers? What's significant for you?
Sure. So I think there's probably two lenses to answer that question. Firstly, through the lens of clients and how they're allocating to sustainability and to strategies that are targeting to support that transition to a low carbon economy. But also the second lens, I think, which is equally important, is to touch, as you've mentioned, those structural trends which are gaining in momentum, and some of what we're doing ourselves in terms of addressing those trends. So from a client perspective, I'd say in 2017 and really in 2018, predominantly the main way for investors to access sustainability, the most common way was through screens and through those exclusionary approaches. So in applying exclusions based on the business activities of a company, or screening out companies that may be deemed to have controversial activities. And you would have seen screens based on revenue thresholds for tobacco producers and the like, or whatever the motivation or whatever that value was for the asset owner or for the wealth manager. So really that was really the predominant approach back in 2017 and even 2018 in terms of sustainable investing. And what you've seen over the last 4 to 5 years, and really a tipping point I would say would be 2020, probably no, partly because of that huge uptick in momentum that you saw of companies and adopting those net zero pledges and the like, which I mentioned, but probably also the pandemic and COVID playing a role. You saw this shift to outcomes and to real world outcomes in particular. And I think that's so this willingness of institutional investors and this motivation for institutional investors to invest in sustainable strategies, to invest in transition strategies, which are achieving a specific outcome rather than paper decarbonisation, which of course you could achieve if you were to solely optimize for a carbon emissions metric in a portfolio. So that shift from solely exclusionary approaches to real world outcomes, either through wanting to remain invested in carbon intensive companies, wanting to invest in those companies that are supplying perhaps critical materials to the low carbon transition, is really, I think, a fundamental shift that's happened over the last 4 to 5 years. And then the second aspect, I think, of that response is that those structural megatrends that are driving the low carbon transition, we talk about three. So we talk about technology and the pace of technological innovation that has been only increasing in pace. We talk about policy and the policy response and the policy driving the transition to a low carbon economy. And then we talk about investor and consumer preferences. And those are three structural trends that have been increasing in momentum. They were already present in 2017, certainly, but they've been accelerating in pace. So if we think about technology, for example, the decrease that we've seen in solar, very, very clearly over the last decade, being a huge technological innovation. And another thing I'd highlight as an example is the capacity that we now have in wind and solar. And recent IEA projections noting that we are now on track to meet the IEA scenarios for the Paris Agreement. That's the pace of innovation that we're seeing in technology, I think, is only increasing and has increased over the last 5 years. From a policy perspective, we've had the IRA, which is, of course, transformational and catalyzing investment, the EU response to catalyzing that investment. And then, of course, the consumer preferences and investor preferences, which we see translated into flows. So 2022 flows remaining resilient despite that volatility that we saw in those asset classes such as equity and fixed income, really. And that's encouraging that those sustainability flows remain sticky here in Europe. So really that end investor preference also remaining a structural megatrend, which we see a driver for the long term, but also increasing in velocity versus 2017.
Just out of interest, I know we're not talking specifically about how private wealth funds come to be allocated, but there's been a lot of talk over the last few years about this big kind of generational inheritance of mega wealth and how that's going to inform different investment strategies. I mean, does that feel like that is already in play? Is that kind of relevant here, or is it actually just all types of investors and all types of assets are now kind of channeling their interest in this way?
Sure, and I think here I'm going to put on my other hat. I actually lead the Women's Network at BlackRock across EMEA. So this is a topic which we discuss actually frequently, how that transformational and the generational transfer of wealth will take place, and what it may mean for investing and for the investing landscape. So from that perspective, around 40% of wealth today is held by women. And actually, a poll recently by a third-party research agency noted that 52% of women want to invest in sustainability products, and that's versus a lower percentage of men. So if we think about it from that lens and that transfer of wealth, which is underway, and the increase in that, and women are positioned to really benefit from that, that could have dynamics in terms of how investors actually allocate in the coming years, specifically in the wealth space. I would say that that's from a wealth perspective. From an institutional perspective, the asset owners typically have net zero commitments or some type of net zero pledge. If we look at our own client base globally, 68% of our largest clients have net zero commitments, and that's 100% of our largest clients here in Europe. So this is really top of mind for our clients, moving from that commitment stage in this region to really implementation. And that's where my team and my role comes into play. We're working with our clients to really transform their portfolios and support them in meeting those objectives that they may have.
Well, let's stay on that kind of trend of the institutional client base. How has their interest shifted? I mean, you mentioned then just now about the huge amount of money that has gone into the development of wind and solar, and clearly renewables is where a lot of that interest has been historically. Where is the institutional interest shifting to? What are you seeing there?
Sure. So thanks, Alex. And I think that's coming back to the point I was making earlier around real world outcomes and the increasing importance of real world outcomes to the institutional investor base. And an additional point I'd like to make is the emergence of these net zero frameworks. So, for example, the Net Zero Asset Owner Alliance framework, the IIGCC framework, the Net Zero Banking Alliance framework, the Science Based Target Initiative, and I can go on. So these are frameworks which are being developed for target users, and they are developed to support that target user that has a specific business model to provide guidelines to transition their portfolio to achieve net zero ambitions as under the Paris Agreement. So specifically, the Net Zero Asset Owner Alliance is for pension funds, it's for insurers. Asset managers can use it because that's a framework which is very much for the business model of those specific types of financial institutions. You also have, as an example, the Net Zero Asset Management Initiative, which is a specific framework for asset managers, and it suits better the business model for those asset managers. So you are seeing this emergence of frameworks which are providing guiding principles to institutional investors as they seek to align their portfolios to net zero. What I would call out, though, as the commonality across those frameworks, and really the 4 principles I'd call out, commonalities, which I think apply more generally as well, even for those financial institutions that may not be members of those frameworks. So firstly, the importance on financed emissions, because those are those emissions linked to the investment activity of the financial institution. So rather those emissions linked to the operations of the institution, which are decarbonized looking at supply chains and the like. These are those frameworks that are now focused on the financed emissions, those emissions that specific financial institution is financing. And then secondly, in line with that is the timeline in terms of emission reduction. So the commonality across those frameworks is the recognition that actually this will take time. There are 2030 milestones, there are 2025 milestones in some cases, but this is a journey that we are on that requires checkpoints and interim targets to ultimately reach 2050. So really that longer timeline. But then thirdly, and I think interestingly, and particularly for this audience, is the treatment of carbon intensive sectors, and that focus on not wanting to have solely paper decarbonization of portfolios, but really to remain invested, to work with companies and to support them on that transition. And if we think incumbents are actually, in many cases, very well positioned to transform their business models and to emerge as the leaders of the future. You have the transition will require a vast rewiring of the global economy. I think that's well recognized. It will require a reworking and relooking of supply chains. It requires looking at every aspect of the value chain of that specific company. And in many cases, incumbents are actually very well positioned to transform their business models and to identify those technologies of the future that will be the winners going forward. So this identification and recognition that remaining invested in carbon intensive companies, I think, is something which has emerged as quite important for institutional investors. And then lastly, engagement. And engagement seen as a critical tool in the toolbox of a financial institution, working with the company to support them on their transition to a low carbon economy, be that engaging on their TCFD reporting, on the robustness of their disclosures, on how the board may be implementing, assessing, evaluating physical risk, transition risk within the operations of that company. So engagement in many different forms. And when I say engagement being really that two-way dialogue between an investor and the company, rather than it solely being, from our perspective, we would not say that solely a letter sent to a company would be an effective engagement. It really needs to be an exchange of views on that company strategy. So I'd say those are the four commonalities that we're seeing emerging amongst these differing frameworks, which are providing those guidelines to institutional investors.
If you were going to identify, I mean, those amongst those commonalities, amongst the discussions you're having, what is the best kind of lever right now to get institutional money really to focus in on industrial decarb? We're not going to make the whole of the rest of the podcast about industry, obviously, but as you brought it up, you're quite right. The kind of treatment of carbon intensive sectors is something that, if we want to get real about decarbonisation globally, you can't ignore the 35% plus emissions that come from those sectors and the materials that are essential. So how do we help channel more of the right money into those sectors, do you think? Probably no simple answers, but give me your best shot.
I don't think there's a simple answer to that question, unfortunately. I think there are, if we think holistically around the tools that are available, to transform and to move the economy to a lower carbon environment, policy obviously needs to be a key lever here, and we are seeing developments with the IRA, we are seeing developments with the EU, but I think the policy embracing disclosures, and providing an investment environment which is welcoming to companies is certainly a lever which we would say is key. So policy really needing to take the front seat here. I think from a finance perspective, there is significant pools of capital now that are looking to allocate to climate solutions and to newer technologies. If we think about emerging markets, for example, we would say there's around $1 trillion that needs to be invested in annually to emerging markets to support that transition to a low carbon economy. And the challenge with emerging markets, of course, is country risk and the heightened risk associated to investing in these countries, which may not fit the risk return profile of institutional investors. And not all of that risk can be diversified away through financial engineering. So at our firm, we do have one blended finance vehicle where we've partnered with three governments and the Grantham Institute to catalyze investment into emerging markets. But these are vehicles which require that they're more complex to launch, they're more complex to manage. And they're more complex to deploy capital from than traditional funding vehicles. So I think the finance sector itself also has a role to play alongside the policy sector. I think the one point, and perhaps to answer your question more directly, would be around disclosures and reporting. So increasing transparency is fundamental to construct portfolios and to construct strategies to catalyze that investment. Investors need data. They need data which they can identify as financially material. And they need data to identify which companies are doing good, which companies are orienting their own business models. So I think robust reporting and robust data and robust disclosures is key.
Well, let's pick up on that data piece then, because I mean, you obviously kicked off this whole podcast talking about the kind of the focus that BlackRock brings, like really rooted in in-depth research analysis. So what is the data that your investors need? And perhaps another way of looking at it is what is the data that we need to leave behind right now that is not helping this, the flow of capital? So what's needed and what do we definitely need to be getting rid of, or what's getting in our way?
Sure. So I think that the first point I would make is around financial materiality. So for investors, data, of course, needs to be aggregated into metrics that are then decision useful, so that an investor can identify those metrics which will impact the valuation of a company over the long term. So I think the decision usefulness of data and of metrics in particular is incredibly important. So I think one point I would underwrite is that no single metric can tell the full story. So if we think about the metrics that are available now, broadly you could categorize them into two categories. The first being backwards looking metrics, so carbon intensity, absolute carbon footprint, emissions, and then the forward-looking metrics, which are those that are perhaps more binary, such as SBTI, science-based targets, benchmarks, and forward-looking ITR, implied temperature rise. So really those metrics which are forward-looking, and they both have a use. So those backward-looking metrics, they're easier to measure, they're easier for investors to understand, and they reflect real-world emissions that are there today. So they certainly have a use case, but they may towards they may have some sectoral regional biases. They may have lower diversification in the number given the data points that are available. If we look at forward-looking metrics, they may be binary in some instances, but they do consider company targets, and often they're based on current emissions data, and they avoid that sectoral regional bias which may be inherent in those backward-looking data sources. So I think that the key point that I would make is that no single metric tells the story. It is the how will that data point and how will that metric be used in the investment process, which is key. From our perspective, perhaps I'll touch on a tool that we've used to bring that to life. We've developed a tool called Aladdin Climate. Aladdin is our risk management system where we house a vast number of data points related to sustainability and other. It's where it's the integrated framework where risk management across whole portfolio is conducted. Investment processes, workflows is built into what we call Aladdin. And we've built a tool called Aladdin Climate. And that is using data sources to identify the physical risk and transition risk and implied temperature rise metric for issuers that can be then calculated and assessed with a number of different variables to calculate the underlying impact on the valuation of the issuer, and it can be aggregated up. So we've partnered with different firms to build out our Aladdin Climate tool, to build out the physical location data to assess physical risk, to build out the models and the transition models to assess those transition risks. But ultimately, that's a tool that we use for TCFD reporting. It feeds into our climate capital market assumptions, and it is a tool that we have to really be able to make use of the data and identify those decision useful data points at the issuer level, which of course is so important for investor. We need to understand the risks, we need to understand the scenarios, how that may unfold under different scenarios. I think, and to the last part of your question around what we may need to not stay attached to at the moment. I think what is extremely promising is the work that the International Sustainability Standards Board is doing at the moment, aggregating some of these differing frameworks. And I think that aggregation is critical for companies who are often faced with onerous reporting requirements and so many different frameworks actually which they need to report to now. And so that aggregation that is now being done through the ISSB, the thinking at the ISSB, setting these international standards, I think will be a pivotal and important tool to help companies, but also investors alike, with a more standardized framework to data and to reporting.
Yeah, well, when you talk about that, I think of a conversation I had in the last couple of weeks actually with one of our industrial clients, and one of her really biggest challenges at the moment is the volume of requests they're getting from all sorts of stakeholders for ever so slightly different types of data that have to be produced in a certain way. And then at the same time, there are other external agencies that are basically, you know, reporting on them either with or without the data from the company. It's just like this, the issue of data is that it sounds like it should be simple, like just give us the data and tell us how you're doing. She's like, but we're facing such different types of requests for similar sets of data, but then also this issue of people reporting on us but without using our data. Like it feels like it's creating well, it's creating a lot of work, but it's also creating potential risk for them actually, and how they're able to source the right partners and financial arrangements. I thought that was kind of fascinating, that sort of the idea of this kind of supposedly, you know, should be quite simple. We just need data. We need to understand how you're performing, but it's not the same question is not being asked, even though perhaps the same data point is the ultimate goal of those different questions. It's sort of a fascinating mess for them to be in, it felt like. Okay, well, let's move on then and have a think about ESG metrics. Been a lot of discussion in different geographies recently about, you know, the role of them and what the right ones are. I mean, there's another of the classic Cameron broad questions for a podcast victim, sorry, but what are the right ESG metrics, do you think? When I say that to you, what does that mean, and how would you determine those?
Yeah, and I think it's a great question. I mean, I'd probably start by giving the overall picture of the sustainable investing landscape to kind of bring that down into how these metrics are used. So at BlackRock, we manage 655 billion in sustainable assets at the end of Q1. So it's a big number. And the overall industry is growing exponentially. So this is an industry which is growing at pace, and in that asset number we have over 400 sustainable products and sustainable strategies. Now, what that means is that those strategies may be using different data points depending on the index construction, depending on if we've co-developed that product with the client, depending on the preference of the client, who may have a preference for a specific provider or the like. So there may be different reasons why we are using different data sources. They may be best suited for the specific exposure, for example. So we do use a wide variety of data sources and metrics across the firm. What we have done, and when we have a commonality, is in a few areas. So firstly, we have reported certain metrics across all of our index funds that are in scope globally, and actually across all of our mutual funds that are in scope globally for some of these metrics. And we have the WACI, for instance, the weighted average carbon intensity, as a metric which is on our website, so it can be seen by all. We have the implied temperature rise metric. We have ESG quality scores. So we have several metrics which we have on all of our mutual funds globally, to really increase that transparency, given that's where we've seen client demand for those metrics. And we see in particular the weighted average carbon intensity metric. It's one where we've seen, you know, quite a lot of significant client demand wanting that metric, and in particular understanding how that evolves over time. So that's one place where we have some commonality in approach. And the other area where we have some commonality in approach with regard to metrics is with regard to our own proprietary scoring framework, which we've constructed, and that uses, once again, a large number of data points as source data, but it aggregates up into 270 KPIs and ultimately into E, S, and G scores, so pillar scores, to provide a score at the overall company level. It's looking at financial materiality. So concretely, it looks, for instance, at Glassdoor data, and it looks at the retention of employees on Glassdoor, as we think there is correlation with company turnover. So it's looking, and each of these descriptors is underpinned by a vast body of research to support the evidencing of that financial materiality. We've used machine learning techniques to fill the gap where data may not be available, where you may have some incomplete data sets. So think about it, how Netflix recommends movies, or how Amazon predicts what customers are doing. We can do the same if there are incomplete data sets, but that's another use case where we've use innovative techniques to really identify the financial materiality of a data set to make a decision useful for an investor. So I think the broad answer will be to the broader question. There isn't one single data point or one single metric which will tell the whole story. It really is. It's a need to look holistically at the different metrics and identify what is this decision useful for that particular strategy that is being built or constructed.
Okay, so a bit of a different kind of question for you. If I guess so far at least from my perspective, we're sort of broadly talking about the more developed markets of, well, you're focused on EMEA, I'm focused on, Europe and North America, but in more emerging markets, or nominally we might call them, riskier regions or so forth. What are we seeing coming to those riskier projects or regions, and what frameworks and tools are emerging?
Sure. So I think the first point I would highlight is the recognition that the emerging markets account for around 2/3 of global emissions. So actually that capital that needs to flow into emerging markets to really decarbonize the global economy, it's critical. And indeed, if we think from a whole portfolio perspective, from a sophisticated institutional investor that wants to achieve real world outcomes, allocating to investments in emerging markets or investments which may decarbonize or some of the infrastructure in emerging markets or technologies that may support the decarbonization within the emerging market it is a priority, given simply the nature of needing to shift the whole global economy to that low carbon trajectory, rather than solely investing in the region which that institutional investor may be in. So firstly, from a client perspective, there certainly is that increasingly that desire to invest in those in areas where they can make the most impact and achieve those real world outcomes. I think the challenge comes once again to de-risking these projects, and public budgetary resources have been shown to be successful in the past to really catalyze that private capital and to really absorb some of those losses that have deterred private investors from allocating into those markets. But more of these partnerships are required, because thinking holistically, the institutional and structural reforms that are required in emerging markets to de-risk at scale probably won't happen in the timelines as required under the Paris Agreement. So more of these blended finance vehicles and ability to shield institutional investors from the higher risks of some of these projects could be a good tool to really mobilize that capital and really de-risk from an institutional investor perspective, to enable them to allocate that capital where it's needed.
Whenever we talk either internally as a team or with clients about kind of emerging markets or higher risk markets, the other thing that is also true is that, and you've already mentioned this earlier, that is the need for policy. So how can funds flow more easily in regions where we're just not really seeing that same commitment or drive to put in place policy, let alone the incentives that you would hope would come with that policy? What do you make of that?
And I think ultimately it depends on client demand and on investor demand. And if we think about our role as a fiduciary, our role is to really build those products where clients are motivated, and to meet the needs of our clients, we're investing in line with those investment guidelines of clients. So I think that impetus really needs to come from our client base and from the institutional investors. And our role is to provide those solutions to enable them to really access those thematics. And an example of an innovative solution which we developed just a few years ago was a partnership that we undertook with a sovereign wealth fund. And there we partnered with a sovereign wealth fund who had climate tech capabilities. And the partnership, we've launched a new product, a new fund called Decarbonisation Partners. And that is a fund which is investing in climate technology, in growth equity. So it's at that growth equity space. It's higher up than your venture capital area of the capital stack. And it's investing in those innovative solutions to really catalyze that investment to a low carbon economy. So I think from our perspective, we partner with institutional investors, with sovereign wealth funds that have that desire to build solutions and to fund solutions to transform or to catalyze that investment to where it's needed.
Was that, just from memory, that was Temasek?
Mm-hmm.
Yeah,
That's right. Yes.
Reading about that, really fascinating to see that coming to life. So with that example of the collaboration with Temasek, with what you're saying about this kind of appetite for real world outcomes, even in higher risk regions, what does that, let's like flip that around, what does that mean for the people, projects, technologies that are trying to attract that capital in those markets? What more do they need to be doing to sort of really be a magnet for this kind of this funding appetite that you're seeing?
Sure, that of course it's a fantastic question. I think industry collaboration and building that network is key. From our perspective, we've launched a new initiative. We announced it at the back end of last year called Transition Capital, and we are looking to bring together. From our perspective, we provide capital solutions across that entire capital stack to companies, and we want to ensure that we're servicing companies with that full range of capital that we have available to support them in investing in the projects that they may need to invest in, especially in particular in that scale-up area. So those projects that typically have low or no technology risk, but aren't yet at that infrastructure equity risk return profile. So we're looking at bringing together our capabilities in a more structured way, and to develop and to catalyze more investment into that transition area. From a company perspective, I think that it's very much building that network and ensuring robust disclosures, robust reporting, and transparency on operations.
Okay, well, let's kind of bring this to a wrap then. I mean, I really feel like we've covered so much ground. I'm going to have to pull you back in for another part two another time. But when you think about, you know, where we've come from in the last 5 years, you sort of talked us through that shift in attention on the types of areas of investment, the shift in demand for different types of data and metrics. Where's your attention turning now? Like what are you looking forward to? What's the sort of next either trend or you know, driver that you guys are trying to respond to?
Sure. So I think that the first trend is very much servicing the sustainability and climate commitments and climate needs of the client base that we have. So allocating to climate solutions, implementing climate into portfolios, providing the data, providing the tools, and the metrics to our institutional clients remains priority number one. So developing those strategies to support them. And then priority number two would be natural capital and biodiversity. We see this very much as an emerging topic of interest for institutional investors. Of course, with the Task Force for Nature-related non-financial disclosures coming out with their recommendations in September, we expect this to really accelerate as institutional investors begin to think around implementation of natural capital, of biodiversity into portfolios. So I think that the two topics remain very much sustainability and climate in particular, and then secondly, natural capital and biodiversity.
And for you personally, like what's your bet for how the next 12, 18 months are going to unfold? What do you think you're going to be focused on most?
I think it will be those two themes. I certainly think it will be servicing our largest asset owner clients and institutional clients in implementing those particular imperatives across the portfolios. And then I think hopefully we'll see more awareness and greater adoption around biodiversity as well in the industry. So I think those two themes are certainly going to be my areas of focus.
Well, Ewa, I mean, as I said at the beginning, yeah, I've been wanting to have you on as my guest for some time, and I feel like I have milked an enormous amount of content out of you. So thank you. You've been very generous with your time, and it's been really interesting to hear from you. Thanks again for joining me.
Thank you, Alex. Delighted.
At Jano Media, we recognise that great content has the power to create impactful and positive change for lives and society. Whether that's video, live streams, photography or podcasts, partnering with us will enable you to harness the power of content to engage, inform, and inspire. Reach out to us today.